Look at question number 26. Capital structure of PQR Limited is as follows. So there are different sources of finance. 10% debenture worth of 3 lakh rupees, 12% preference shares worth of 2 lakh rupees, equity share capital 5 lakh 50,000. Face value of the equity share is given rupees 10 per share. Total capital employed by the company is 10 lakh 50,000. Rupees 100 per debenture redeemable at par has 2% flotation cost and 10 years of maturity. The market price per debenture is rupees 110. So in this question, what is the face value of the debenture? Rupees 100 is the face value of the debenture. Coupon rate is how much? Coupon rate is 10% given here, and market price of the debenture is given rupees 110. So if face value of one debenture is 100 rupees, then value of how many debentures will be 3 lakh? If value of one debenture is 100, then value of how many debentures will be equal to 3 lakh? 3 lakh divided by 100, we get 3000. So there are 3000 debentures outstanding, and market value of one debenture is 110. So how do we calculate the total market value of the debenture? 3000 into 110. Similarly, and one more important thing, here 2% flotation cost is mentioned, but they have not mentioned whether flotation cost needs to be calculated as a percentage of face value or issue price. If nothing is mentioned, it is better to calculate using the issue price. And in this question, issue price is also not given. If issue price is not given, we will assume the debentures are issued at the market price. Next, rupees 100 per preference shares redeemable at par has 2% flotation cost and 10 years of maturity. The market price of the preference share is rupees 108. So exactly similar to the debenture redeemable preference share. So the formula is going to be the same, but the only difference is interest is tax deductible. So interest will give us tax savings. Preference dividend is not tax deductible. So preference dividend will not give any tax savings. Equity share has flotation cost of rupees 4 and market price per share is rupees 25. The next year expected dividend is rupees 2 per share with annual growth rate of 5%. So this 2 rupees is D0 or D1? D1, why? Because it is the next year dividend, which is a future dividend. So 2 rupees is the D1. So D1 is directly given. We don't need to calculate it. We just need to apply the numbers in the formula. Growth rate is again directly given 5%. The firm has a practice of paying all earnings in the form of dividend. Now why this is necessary? There is no retained earnings. So this equity share worth of 5,50,000, it came from the issue of equity share capital only. There is no retained earnings included in the equity. Corporate tax rate is 30%. Requirement of the question is to calculate weighted average cost of capital using market value weights. So we already calculated there are 3000 debentures outstanding. Now, what is the face value of one preference share? 100. Total value of preference share is 2 lakh. So how many number of preference shares are outstanding? 2 lakh by 100 we get 2000. So market price of one preference share is given as rupees 108. So market value of total preference shares will be 2000 into 108. Similarly, we have total equity share capital of 5,50,000. Face value of one share is rupees 10 per share. So how do we calculate the number of outstanding equity shares? 5,50,000 divided by 10. So we get 55,000 equity shares are outstanding. So now since the requirement of the question is to calculate WACC using market value weights, we don't need to worry about the book value. We can directly start with the answer. Question number 26, working note 1. So what should be the first working note? Calculation of market value equity preference in equity share capital, then preference share capital, then we have debentures. Now listen, in this question there is no retained earnings, but if there is a retained earnings, do we need to calculate the market value of retained earnings separately? No. Why? Because market value of the retained earnings, it was included in the market value of equity share itself. Yesterday we solved one question. We solved the MTP May 2020 question, right? So while calculating weighted average cost of capital using market value weights, market value of retained earnings should be excluded because market value of retained earnings is already reflected in the market value of equity. So how many equity shares are outstanding in this question? It is 55,000. And what is the market price of one equity share? Market price of one equity share is rupees 25. So 55,000 into 25, how much do we get? 13 lakh. 75,000. Market value of equity shares. Preference share capital, number of outstanding preference shares is 2,000. And the market price of one preference share is rupees 108. 2,000 into 108, how much do we get? 2 lakh. 16,000. Then debentures, 3,000 outstanding debentures, 3,000 into market prices 110. 3,30,000. So working note 1 is done. Now what is the second working note? Calculation of cost of debt, cost of preference share capital and cost of equity. First let's calculate the cost of debt. In this question, the debt is a redeemable debt or irredeemable debt? It is a redeemable debt. So what is the formula for calculating cost of redeemable debt? It is I into 1 minus T plus RV minus NP whole divided by N divided by RV plus NP whole divided by 2. Clear? Cost of debt is equal to, for debt what is the coupon rate in this question? 10%. Face value is rupees 100. So what is the amount of interest the company has to pay? 10 rupees into 1 minus tax rate given in the question is 30%. So 1 minus tax rate plus, in the question it is clearly mentioned that the debentures are redeemable at par. Par value is nothing but face value. So the debentures are going to be redeemed at 100 rupees minus, what are the net proceeds? See, the net proceeds we cannot take the market price directly because we have a flotation cost of 2%. So net proceeds is equal to issue price minus flotation cost. In this question, since issue price is not directly given, we are assuming that the debentures are issued at the market price. Market price is 110 minus there is a flotation cost of 2%. It is always better to calculate flotation cost on issue price rather than face value. So 110 into 0.02. How much do we get? 107.8. 100 minus 107.8 whole divided by, what is the N? 10 years. Redemption value is 100 plus net proceeds is 107.8 whole divided by 2. So what is the cost of debt? 5.9. 5.99%. Everyone done till this point? Any doubt? Next, calculate the cost of preference share capital. So first, in this case, the preference share is a redeemable preference share. So what is the formula? The formula for calculating redeemable preference share is exactly similar to cost of redeemable debentures, but the only difference is instead of interest we are going to pay preference dividend to the preference shareholders, and interest is multiplied with 1 minus T because interest gives tax savings to the company. But for preference dividend, there is no tax savings for the company. So directly we should not multiply preference dividend with 1 minus T. So preference dividend plus RV minus NP by N divided by RV plus NP divided by 2. So cost of preference share capital is equal to the coupon rate on preference share, it is 12%. Face value of preference share is rupees 100. So preference dividend paid will be 12 rupees plus. In the question it is clearly mentioned the preference shares are redeemable at par. So redemption value is 100 minus. What is the net proceeds here? The issue price is not directly first. Net proceeds is equal to issue price minus flotation cost. But issue price is not directly given. We can assume preference shares are issued at the market price. So 108 minus flotation cost is 2%. So 108 into 0.02. How much do we get net proceeds? 105.84. So 105.84 rupees is the net proceeds from preference shares. So the number of years is 10 divided by 10 whole divided by 100 plus 105.84 divided by 2. How much do we get? Cost of preference 11.09%. Clear so far? Now let's calculate the cost of equity. So in this case, which formula can be used for calculating the cost of equity? The Gordon's approach or growth approach. So what is the formula for calculating cost of equity using Gordon's approach? D0 into 1 plus G divided by P0 plus G. Or we can write it as D0 into 1 plus G is nothing but D1 by P0 plus G. Cost of equity is equal to, in this question D1 is directly given because 2 rupees is the expected dividend for the next year. So D1 is 2 divided by, what is the market price? Market price is 25 rupees per share, but again there is a flotation cost of rupees 4. So 2 divided by 25 minus 4 plus, what is the growth rate? 0.05%. Sorry, 0.05 or 5%. So growth rate is 0.05. So what is the cost of equity we get? 2 divided by 21 plus 5%. 14.54%. 14.54% is the cost of equity. 52. So far clear? Any doubt?
This divided by this is not the minimum.
How this can be 12.58? This should be negative, no?
It's negative.
100 minus 105.8 divided by 10. So it is minus 5.8, not plus 5. Everyone done till this point? Now we have all the relevant information for calculating the weighted average cost of capital using market value weights. So what is the format? First we have to write source, then next cost, weights. So cost is nothing but C and weights is nothing but W, then W into C. So in this question we have 3 sources of finance. First we have equity share capital. So what is the market value of equity? It is 13,75,000. Next we have preference share capital. How much? 3,30,000. Then debentures, it is 2,16,000. Correct? Oh, sorry, 3,30,000. 3,30,000. Okay, so debenture is 3 lakh and preference share is 2 lakh 16,000. Preference share capital market value is 2 lakh 16,000 and debentures 3 lakh 30,000. What is the total market value of the company? 19 lakh? 19 lakh 21,000. Now what is the cost of equity we calculated? 14.54 percentage. So this is from 52 percentage. This is from working note 2. And cost of preference share capital 11.09 percentage from working note 2. Debentures 5.99 percentage from working note 2. So now what are the weights? Weight of equity, weight of preference share capital and weight of debentures. 1375 divided by 1921. How much do we get? 71.58%. 2 lakh 16 by 1921. 11.24 percentage. 330 by 1921. 17 point. So now multiply weights into cost, mean individual weights into individual costs, and add everything, we get the weighted average cost of capital. So what is the first? 10.39. .25, 1.038, 38 or 3. Okay. So add everything. What is the weighted average cost of capital? 12.67% is the weighted average cost of capital using market value weights. Everyone done till this point? Clear? Any doubt in this question? Everyone done? Shall we start with the next question, next topic? So write on the next topic, marginal cost of capital. Marginal cost of capital. Write down marginal cost of capital. So listen. Marginal cost of capital is the cost of obtaining an extra rupee of capital. In practice, since capital is usually raised in large amounts, the marginal cost refers to the expense involved in raising new funds. So what they are saying is, for example, let's say the existing capital of an organization is, let's say 10 lakh rupees. And for raising this 10 lakh rupees, let's say the weighted average cost of capital of the company is 10%. So 10 lakh is the capital, 10% is the overall weighted average cost of capital. Now let's say the company wants to raise an additional finance of another 2 lakh rupees. Now for raising this 2 lakh rupees, let's say the weighted average cost of capital of the company is, I'm talking only about this 2 lakh rupees. For raising this 2 lakh rupees, the cost of capital is, let's say, 12%. Now what is the marginal cost of capital? Is it 2% or 12%? It is 12% because marginal cost of capital is nothing but the cost of raising new funds. In this case, what are the new funds? 2 lakh rupees is the additional funds or new funds that the company is raising. What is the cost of raising this additional 2 lakh rupees? 12%. So the 12% is nothing but marginal cost of capital. So to put it very simple, marginal cost of capital is nothing but the cost of raising additional funds or new funds. In this case, marginal cost is not 2%, it is 12% because the new funds is 2 lakh rupees. What is the cost for raising this 2 lakh rupees? 12%. So marginal cost of capital is 12%. Is this point clear? Any doubt in this? Did you all understand what is marginal cost of capital? Now listen, marginal cost of capital is equal to cost of retained earnings if new funds are raised using the retained earnings. Which means, for example, let's say the company wants to raise 2 lakh rupees of additional capital, but let's say they have 5 lakh rupees of retained earnings itself. So in that case, the company may wish to use the retained earnings part instead of going for outside source of finance, right? So in such cases where companies are raising additional finance using retained earnings only, the marginal cost of capital is nothing but cost of retained earnings. So when additional finance are raised using only the retained earnings, marginal cost of capital is nothing but cost of retained earnings. And yesterday we discussed how to calculate cost of retained earnings, right? What is the formula for calculating cost of retained earnings? It is same as the cost of equity, but the only difference is equity has flotation cost, retained earnings does not have flotation cost. So the other name for retained earnings is nothing but existing equity. So while calculating cost of retained earnings, P0 should be issue price or market price. It is an existing equity. First preference should be given to market price, right? Whereas while calculating cost of equity, P0 will be the issue price. And we also discussed one more formula. Cost of retained earnings is equal to cost of equity into 1 minus F into 1 minus T, which is the T is nothing but what tax? Not corporate tax, but it is the personal tax rate. So marginal cost of capital is equal to cost of retained earnings if additional funds are raised using the retained earnings only. Is this part clear? Any doubt in the first point? Now look at the second point. Marginal cost of capital is equal to WACC or weighted average cost of capital if the funds are raised in proportional manner and components cost remain unchanged. So listen, this is something which is important to understand. Weighted average cost of capital is affected by two components or two factors. What are they? One is, how do we calculate weighted average cost of capital? We are multiplying weights into cost and then we are adding it. So it is affected by two components. One is weight and the other one is cost. So if weights is also not changing, if cost is also not changing, then marginal cost of capital will be equal to weighted average cost of capital itself. So let me give you an example. For example, let's say marginal cost of capital is equal to weighted average cost of capital. For example, let's say the organization has an existing capital of 10 lakh rupees. Out of this 10 lakh rupees, let's say 5 lakh rupees, out of this 10 lakh rupees, let's say out of this 10 lakh rupees, let's see, equity share capital is 5 lakh rupees and preference share capital is 3 lakh rupees and debentures is, let's say, 2 lakh rupees. Now what is the proportion of equity share capital? Total capital is 10 lakh, out of which 5 lakh came in the form of equity. So 50% is equity share capital, 30% is preference share capital, 20% is debentures or debt, right? Now let's assume cost of equity is equal to, let's say, 12%, cost of preference share is equal to let's take 9%, and cost of debt is equal to, let's say, 6%. In this case, what will be the weighted average cost of capital? How do we calculate it? Just we have to multiply the weights into the cost. What is the weighted average cost of capital here? .9%. Now listen, this 10 lakh rupees is the existing capital. Now let's say the company wants to raise an additional capital of 2 lakh rupees. So now 2 lakh rupees is the additional capital. Out of this 2 lakh rupees, let's say 1 lakh rupees is equity share capital, and 60,000 rupees is preference share capital, and the remaining 40,000 rupees is debentures or debt. Now what is the proportion of equity here, or weight of equity? 50%. Weight of preference share capital? 30%. Weight of debentures? How many percent? 20%. Right? Now let's assume here also we are raising 1 lakh rupees of equity, right? For this also, let's assume cost of equity is 12%, cost of preference share capital is 9%, and cost of raising this 40,000 rupees, cost of debt is, let's say, 6%. Now what is the marginal cost of capital? See first, what is the marginal capital here? Marginal capital is 2 lakh rupees. What is the cost of raising this 2 lakh rupees? Average cost, weighted average. Still we are getting the same 9.9%. Weighted average cost of capital is equal to marginal cost of capital if the weights is also not changing and the cost is also not changing. Is it clear? Any doubt? So here also 50% equity, here also 50% equity, 30% preference, 30% preference, 20% debt, 20% debt. KE is same under both the situation, KP is also same, KD is also same. So weighted average cost of capital is affected by two components. One is weight, other one is cost. If weights is also remaining constant and cost is also remaining constant, weighted average cost of capital will be exactly equal to the marginal cost of capital. So second point clear? Any doubt in this? Now look at the third point. Marginal cost of capital needs to be calculated using the following steps if funds are raised with different cost of capital with changed proportion. So what they are saying is, see, if new funds are raised in the form of retained earnings, marginal cost of capital is exactly equal to cost of retained earnings. If new funds are raised with same weights, with same cost, marginal cost of capital is equal to weighted average cost of capital. But sometimes what will happen, this new funds will be raised at different proportions. It is not necessary that 50% equity, 30% preference and 20% debt needs to be maintained. Sometimes weights may change, and beyond a certain point this cost will also change. So when weight is also changing, or when cost is also changing, we have to calculate marginal cost of capital using the three steps. Did you all understand when do we need to calculate marginal cost of capital? We have to calculate marginal cost of capital when the funds are raised with different proportions with different individual costs element, with individual cost components. Clear? Any doubt? So the first step in the calculation of marginal cost of capital is we have to establish the composition of new financing, which is nothing but determining the weights. So we already know how to determine the weight. Here we did know 50% equity. So like this we have to calculate or determine the weights. So that is the first step. Estimating the proportion of percentage of the composition of new financing. Second step, we have to calculate the breaking points at different levels of each sources. Now what is breaking point, how to interpret it and how to calculate it, we will discuss while doing the concept analysis. Third step is to calculate weighted marginal cost of capital for each range of financing, right? So first step is to determine the weights. Second step, calculating the breaking points. Third step, we have to calculate the weighted marginal cost of capital. Now let's take this concept analyzer to understand how to calculate marginal cost of capital. But before that, what is marginal cost of capital and when it needs to be calculated. Is this clear? Any doubt? Sorry? Marginal cost of capital is nothing but, so look at this. For example, let's say the company has an existing capital of 10 lakh rupees. The weighted average cost of this 10 lakh rupees is 10%. Now the company wants to raise an additional capital of 2 lakh rupees. For raising this 2 lakh rupees, the average cost of capital is 12%. In this case, what is the marginal cost of capital? Not 2%, it is 12%, because marginal cost of capital is nothing but the cost of the expense involved in raising new funds. In this case, what is the new funds? 2 lakh. What is the cost for the 2 lakh rupees? 12%. So that is the marginal cost of capital. See, that we will study here. Beyond a certain point, if an organization is having more and more debt, the interest rate will increase. To put it very simple, if your friend is borrowing 1 lakh rupee from you, if your friend is borrowing, let's say 10,000 rupees from you, you may charge 5% interest. If your friend is borrowing 10 lakh from you, you will charge 15% interest. So as the amount is increasing, the cost component will start increasing. The total capital is 12 lakh, no? You are going beyond a certain point of debt. Already you have, this 10 lakh has some amount of debt. Beyond that, beyond a certain point, you are asking more and more debt from your lenders. So you will understand it in the concept analyzer. You will understand it. No, the formula is same as weighted average cost of capital. Weights into cost, that's it. So to answer your question, listen, here you can see up to 1 lakh rupees, the company can borrow at 7.1%. If they are going beyond 1 lakh rupees, the cost is increasing, right? So look at the concept analyzer. A firm wishes to raise funds up to 10 lakh rupees and finds that its weighted marginal cost of capital depends upon the amount of funds raised. The firm has set pattern of financing, that is 75% shareholders fund and 25% debt. Now, in the calculation of weighted marginal cost of capital, what is the first step? We have to determine the weights, right? So the first step is already solved in the question. In the question itself, they have clearly mentioned, out of this 10 lakh rupees, 7,50,000 is shareholders fund, and the shareholders fund includes both equity share capital as well as preference share capital, and 25% is debt. So the first step is already done. Determining the weights is already done. So we have to start from the second step. The shareholders fund may be taken. The shareholders funds may be taken as consisting of retained earnings and capital. So what is important is, the shareholders fund is not just share capital, it also includes some amount of retained earnings. The following costs for each source have been estimated at different levels of financing from that source. So here, up to 1,50,000 rupees, you can raise shareholders fund at the rate of 12%. But if you are going beyond 1,50,000 and if you are within the 6 lakh rupees range, you can raise shareholders funds at 14% cost. Is this clear? So if you are going beyond 6 lakh rupees and if you are within the 9 lakh rupees range, you can raise shareholders fund at the rate of 17%. Similarly, for bonds or debt, up to 1 lakh rupees, you can borrow money at 7.15%. But when you are going beyond 1 lakh rupees and you are within the 2 lakh rupees range, you can borrow money at 8.57%. And when you are going beyond 2 lakh rupees and you are within 3 lakh rupees, you have to borrow money at 11.43%. So as the amount of borrowing increases, or as you are employing more and more capital into the business, your investors are expecting more return from the company. I hope it is clear, right? See, this is a cost from the company's perspective, but this is nothing but return from the investor's perspective. So as they are investing more and more money into your business, they are expecting more and more return. Now requirement of the question is find out the weighted marginal cost of capital at different breaking points given that the tax rate is 30% and retained earnings of the company is 1,50,000. The retained earnings of the company of 1,50,000 will be provided by the current earnings at specific cost of capital of 12%. So what is this 12%? 12% is nothing but cost of retained earnings. So the existing retained earnings of the company is 1,50,000 and the cost associated with this 1,50,000 is 12%. That is what they have given here also. Up to 1,50,000 rupees, the firm can finance at the rate of 12%. So this 1,50,000 is nothing but retained earnings. Clear? And the cost of retained earnings is 12%. Is this point clear? Any doubt in this? Now let's go step by step. Write down concept analyzer. Marginal cost of capital. So listen, what is the first step in the calculation of marginal cost of capital? We have to determine the weights. So step 1, determination of composition of funds or weights. Determination of composition of funds. So the first step is already solved in the question. Shareholders fund is how many percentage? 75%. And debt fund is 25%. Clear? Now step 2. What is the second step? Second step is to calculate breaking points. Second step, calculation of breaking points. Listen, first we will just discuss how to calculate breaking points. How to interpret the breaking point, we will discuss it after the calculation. Right? What is breaking point? How to interpret it? We will discuss it after the calculation. First, let's focus on how to calculate the breaking points. So now in this question, how many sources of finance we have? Two sources. One is shareholders fund and bonds or debt. Right? So we have to calculate breaking points for each source of finance. Right? We have to calculate breaking points for shareholders fund as well as for the bonds, right? And within shareholders fund we have different level of limits, right? So for each level of limit we have different breaking points. So here we have 3 different limit points for shareholders fund, right? So for shareholders fund alone we will calculate 3 breaking points. Similarly for debt or bonds we have 3 points where 3 limiting points. So we will calculate 3 breaking points for bonds alone, right? So write down first breaking points for shareholders fund. Breaking points for shareholders funds, and write down the formula. Breaking points for shareholders fund is equal to write down the range where KE changes divided by weight of KE. Sorry, weight of equity, not KE. The range where KE changes divided by weight of equity. The range where KE changes divided by weight of equity. This is nothing but change symbol, right? The rate where KE changes divided by weight of equity. So listen, in this question, up to 1,50,000 rupees, we can raise shareholders fund at 12%. But if you are going beyond 1,50,000 rupees, cost of equity is 14%. So I can say that 1,50,000 is one range where KE is changing. You're all getting the point. So breaking point 1 is equal to 1,50,000 divided by, what is the weight of equity or weight of shareholders fund? Weight, that is cost, 12% is cost. Weight is 75% divided by 0.75. So what is the first breaking point we get? Rupees 2 lakh. Is this clear? If you have any doubt in this, please do ask. Weight of equity is 75. Shareholders fund 75%. Is this clear? Any doubt? Now similarly, let's calculate the second breaking point. Breaking point 2. So up to 6 lakh rupees we can raise shareholders fund at 14%. But if you are going beyond 6 lakh rupees, cost of equity changes to 17%. So we can say that 6 lakh is the point where KE changes. So first at 1,50,000 rupees KE changes. Next at 6 lakh rupees KE changes. So breaking point 2 will be 6 lakh divided by, what is the weight of equity? Same, 75%. We get how many rupees? 8 lakh. Is this point clear to everyone? Did you all understand what we are doing? See, what is this 2 lakh? How to interpret it? We will discuss later. But is the calculation part clear? Next, breaking point 3. You tell me the next range where KE is changing. It is 9 lakh rupees divided by weight of equity is 75%. 12 lakh is the third breaking point. So here we have 3 ranges where KE is changing. So we have calculated 3 breaking points. Clear? Now similarly we have to calculate breaking points for bonds or debt funds. Breaking points for bonds. So what could be the formula for calculating the breaking point for bonds? Range where? Range where? For equity it is KE changing. So here it is the rate where KD changes, the range where KD changes divided by weight of debt. Clear? So now up to 1 lakh rupees we can borrow at 7.15%, but we are going beyond 1 lakh rupees, KD is increasing to 8.57%. So 1 lakh divided by, what is the weight of debt? So this is breaking point 1, 0.25. How much do we get? 4 lakh. So this is 4 lakh rupees. Okay. Second breaking point. So up to 2 lakh rupees we can borrow at 8.57%. If you are going beyond 2 lakh, KD changes. So 2 lakh divided by 0.25 rupees 8 lakh. Next breaking point 3. Up to 3 lakh rupees we can borrow at 11.43%. If you are going beyond that, KD will change, but it will increase to how many percent? It is not given in the question. So 3 lakh rupees divided by 0.25. How much do we get rupees? 12 lakh. So far clear. Calculation of breaking point, is this clear to everyone? Now listen. For equity we have 3 breaking points, 2 lakh, 8 lakh and 12 lakh. For bonds we have again 3 breaking points, 4 lakh, 8 lakh and 12 lakh. Now let's see how to interpret this. So just write the breaking points in ascending order. Breaking points in ascending order. Just leave some space on the left hand side and write it down. We have 2 lakh rupees, then 4 lakh. See here, for equity we have 2 lakh. Then in the bonds we have 4 lakh. And equity we have 8 lakh and 12 lakh. For bond also we are having 8 lakh and 12 lakh. So we don't need to write it twice. Just write it once. 8 lakh and 12 lakh. Clear? Now listen. If the company is rising, listen, I am telling how to interpret this breaking point. Listen. If the company is raising an additional capital up to 2 lakh rupees, their weighted marginal cost of capital will remain the same. Which means, you take any number between 0 to 2 lakh rupees. You take 1 lakh, 1 lakh 25, 1 lakh 50,000, 1 lakh 30,000. Their weighted marginal cost of capital will remain the same. But if the company is raising an additional capital more than 2 lakh, but if they are within 4 lakh, so any number between 2 lakh and 4 lakh, 2 lakh 50,000, the marginal cost of capital of 2 lakh 50,000 and marginal cost of capital of 3 lakh will be the same. And marginal cost of capital of 2 lakh 50,000, 3 lakh and 3 lakh 50,000 will be the same. So any number between 2 lakh and 4 lakh will have the same marginal cost of capital. Similarly, for an additional capital of 4 lakh rupees to 8 lakh rupees, the marginal cost of capital will remain the same. For 8 lakh rupees to 12 lakh rupees, the weighted marginal cost of capital will remain the same. To put it in a graph, if you put it in a graph, you will be able to understand it much better. So here we have 0, 2 lakh, 4 lakh, 8 lakh and 12 lakh. So any additional capital from 0 to 2 lakh will have the same cost of capital. But if you are going beyond 2 lakh, cost of weighted average cost of capital, the marginal cost of capital will increase, and again it will remain constant till 4 lakh rupees. Till 4 lakh it will remain constant. But if you are going beyond 4 lakh, it will increase, and again it will remain constant till 8 lakh. If you are going beyond 8 lakh, it will increase and it will remain constant till 12 lakh. So basically it looks like your step fixed cost. Your step, you know what is a step fixed cost, right? So it looks like your step fixed cost. So did you understand how to interpret breaking point? Breaking point is the level of additional capital that can be raised without changing the marginal cost of capital. So here any number between 0 to 2 lakh will have the same marginal cost of capital. Any additional capital of 2 lakh rupees to 4 lakh rupees will have the same marginal cost of capital. 4 lakh to 8 lakh will have same marginal cost of capital, and 8 lakh to 12 lakh will have the same marginal cost of capital. Is this clear? Any doubt? Now why it will remain constant, I will explain. But did you all understand the meaning? Any doubt in this? Clear? Now listen. You take any breaking point, for example, let's take 2 lakh rupees, right? So an organization wants to raise an additional capital of 2 lakh rupees. So what is the proportion of debt and equity mentioned in the question? Shareholders fund is 75% and debt fund is 25%. So what is 75% of 2 lakh? We get 1 lakh 50,000. What is 25% of? We get 50,000. Now listen, just focus on this 1 lakh 50,000. If the company wants to raise an additional capital of 2 lakh rupees, they want 1 lakh 50,000 rupees of shareholders fund. Now from where this 1 lakh 50,000 will come? It will come from the retained earnings, right? Just sit for 2 minutes. Listen, this 1 lakh 50,000 will come from retained earnings. So up to 1 lakh 50,000 rupees, cost of equity is how much? 12%. So now just look at this point. Let's take 2 lakh 10,000. Additional capital of 2 lakh 10,000 is required. What is 75% or what is the amount of shareholders fund? Debt, how much? 1 lakh 50,000. 500. This one? 157,500. 157,500. Okay, 157,500. Dipped or bond is 52,500. Now listen, when the company is going beyond 2 lakh rupees, the shareholders fund is going beyond 1,50,000 rupees. So, if the company wants to raise 2 lakh rupees, listen to this point carefully. If the company wants to raise 2 lakh rupees of additional capital, shareholders fund can be raised at the cost of 12%. So, cost of this 1,50,000 will be 12%. But if the company wants to raise an additional capital of, let's say, 2,10,000, what is the shareholders fund? 157,500. What will be the cost of this 1,57,500? It will be raised at a cost of 14%. So now what is important to understand is weighted marginal cost of capital, weighted average cost of capital is affected by two components. One is cost, other one is weight. In this case, weight is changing or not? Weight is not changing. 75%, 75%, 25%, 25%. Weight is not changing. But what is changing? Cost is changing. Here it is 12%. Here it is 14%. So one component of the weighted average cost of capital is changing. If one component changes, can we say weighted average cost of capital will be equal to marginal cost of capital? Can we say this or not? We cannot say this. Why? Because cost is changing. Cost of equity is changing here. I hope you are getting the point. So why 2 lakh is the break point or breaking point? Because up to 2 lakh rupees only you can raise shareholders fund at 12%. If you are going beyond 2 lakh rupees, you have to raise shareholders funds at 14%. So one component for calculating weighted average cost of capital is changing. So marginal cost of capital will not be equal to weighted average cost of capital. So in those cases, what we have to do? We have to calculate the marginal cost of capital. Is this point clear? Any doubt? Now let me quickly take one more break point and explain it. For debt, let's say 8 lakh rupees. Let's say the organization wants to raise an additional capital of 8 lakh. What is shareholders fund? 6 lakh, 75% is 6 lakh rupees. 25% is how much? 2 lakh rupees we get. So 2 lakh rupees, right? So this is debt, this is shareholders fund. So now, this 6 lakh rupees can be raised at the cost of how many percent? 14%. Up to 6 lakh rupees you can raise equity shareholders funds at 14% cost. So here KE is equal to 14%. This 2 lakh rupees can be raised at the cost of 8.57%. It is debt, not equity. So this is KD is equal to 8.57%. Now let me take a figure that is greater than 8 lakh. Let's take 8 lakh 10,000. What is the shareholders fund in this case? And bond amount. Here it is 6 lakh 7,500 and 2 lakh 52,500. 2 lakh 2,500. Okay. Now here this 6 lakh 7,500 can be raised at the cost of 17%. So here KE is 17%. This 2 lakh 2,500 can be raised at a cost of 11.43%. So here what is happening? Weight is constant. 75% shareholders fund, 25% debt. That is same under both the situation. But what is happening? Cost of equity is 14% here. Cost of equity is 17% here. Cost of debt is 8.57% here. And here it is 11.43. So we say 8 lakh rupees is one of the breaking points. Why? Because if you are raising an additional capital of 8 lakh rupees, shareholders fund can be raised at the cost of 14%. But if you are going beyond 8 lakh rupees, shareholders fund can be raised at a cost of 17%. Similarly, if you are raising an additional capital of 8 lakh rupees, debt can be raised at the cost of 8.57%. But if you are going beyond 8 lakh, debt has to be raised at a cost of 11.43%. So these are all the interpretation of breaking points. Did you all understand why we are calculating the breaking points? calculation, what is breaking point and how to interpret it. Is this point clear? Any doubt in this? Now we are done with two steps. First, we determined the weights or composition of funds, and then we calculated the breaking points. Now what is the third step? Third step is to calculate weighted marginal cost of capital. Now how to calculate weighted marginal cost of capital, we will discuss now. Weighted marginal cost of capital, that is average only, we have to take the average. Now listen, look at the requirement of the question. Find out weighted marginal cost of capital at different breaking points. So how many breaking points we calculated here? 3 or 4? 4 breaking points we calculated. 2 lakh, 4 lakh, 8 lakh and 12 lakh. Totally we have 4 breaking points. So how many weighted marginal cost of capital we have to calculate? 4 marginal cost of capital we have to calculate. One is from 0 to 2 lakh. Then 2 lakh to 4 lakh on marginal cost of capital, 4 lakh to 8 lakh on marginal cost of capital, 8 lakh to 12 lakh another marginal cost of capital. Is this clear? Any doubt? So write on the third step, step 3, calculation of step 3, calculation of weighted marginal cost of weighted marginal cost of capital. So calculation of weighted marginal cost of capital up to rupees 2 lakh. So if the company is raising an additional capital of 2 lakh rupees, they are going to raise this 2 lakh rupees using two sources of finance. One is equity and debt, but here it is actually retained earnings, but retained earnings is a part of equity. So we can write it as shareholders fund and bonds. Funds, costs and weights and W into C. So in this question, weights is directly given, 75% shareholders fund and 25% debt. So what is 75% of 2 lakh rupees? We get 1,50,000. 25% of 2 lakh we get 50,000. Now what is the cost of raising 1,50,000 rupees of shareholders fund? 12% is the cost here, and here it is cost of raising 50,000 rupees of bond. It is 7.15%. Wait. We can't take the 7.15% directly. Wait. Because 7.15% is pre-tax. Tax rate is given in the question, 30%. So how do we calculate the after-tax cost of debt? I into 1 minus T. So 7.15 into 1 minus 0.3, how much do we get? 5.005%. So weights into costs, here it is 9%, 75% of 12, 5.005 and sorry? The tax applicable to the firm is 30%. So here how much? 25% into 5.005, how many percent? 1 point? So totally weighted marginal cost of capital up to 2 lakh rupees is 10.25%. So weighted marginal cost of capital up to rupees 2 lakh is equal to 10.25%. So listen, weighted marginal cost of capital is also weighted average cost of capital. But the difference is weighted average cost of capital is for existing funds, weighted marginal cost of capital is for additional funds or new funds. That's the difference. Now similarly, calculation of weighted marginal cost of capital up to how many rupees we have to calculate? 4 lakh rupees. So calculation of weighted marginal cost of capital up to rupees 4 lakh. So write down source, funds, weights, costs and W into C. So here again we have shareholders fund and bonds. So what is the weightage of shareholders fund? It is same 75% and 25%. So calculate 75% of 4 lakh we get 3 lakh rupees. 25% of 4 lakh we get 1 lakh rupees. Cost of rising shareholders fund of 3 lakh rupees. 14%. Did you all understand how it is 14%? Because 3 lakh rupees is between 1,50,000 and 6 lakh. So it is 14%. And cost of raising 1 lakh rupee of bond is same 7.15%. How much do we get? Oh sorry, yeah, we have to take 7.15 into 1 minus 0. Into 1 minus 0.3. So we get 5.005%. How much do we get? 10.5%. Then 1.25%. So totally it is 11.75. So weighted marginal cost of capital weighted marginal cost of capital up to rupees 4 lakh rupee of additional finance is equal to 11.75%. Is this clear? Any doubt so far? Similarly, calculate weighted marginal cost of capital of funds up to rupees 8 lakh. So 8 lakh and 12 lakh you calculate and tell me the cost of capital for both 8 lakh and 12 lakh. Or else for 8 lakh I will do, for 12 lakh alone you do. Source, funds, so here we have shareholders fund and bonds for debt. Shareholders fund, debt. Weight is 75% shareholders fund and 25% debt. So what is 75% of 8 lakh we get? 6 lakh rupees. 25% of 8 lakh we get 2 lakh rupees. So what is the cost of raising 6 lakh rupees of shareholders fund? It is 14%. Cost of raising 2 lakh rupees of bonds, it is 8.57, but don't take 8.57 directly, that is pre-tax. We have to calculate post-tax. 8.57 into 1 minus 0.3. How much do we get? 5.7 point? Oh, 5.9%. Yeah, if it is 5.999, we can round it to 6%. 6%. Sorry, 10.5. 10.5% and 6% of 25. So totally it is 12%. So this is the weighted marginal cost of capital up to rupees 8 lakh. Similarly, you calculate it for 12 lakh and tell me the numbers. cost of debt 11.43 into 1 minus 0.3 you should take. So did everyone get 14.75 weighted marginal cost of capital for 12 lakh rupees? Did everyone get it? Is there anyone who wants me to solve, or did everyone get it? 14.75. Everyone got 14.75. So now listen. If the company wants to raise, if the company wants to raise an additional capital of up to 2 lakh rupees, what is their marginal cost of capital? 10.25%. So, if the company wants to raise up to 2 lakh rupees of additional capital, their marginal cost of capital is 10.25. If they want to raise an additional capital somewhere between 2 lakh to 4 lakh, it is 11.4 lakh to 8 lakh? 12 point? Oh, 12%, okay. 8 lakh to 12 lakh? 14.75%. Now listen, in this question, what is the additional capital that the company wants to raise? 10 lakh rupees. So what will be their marginal cost of capital? 14.75. Why? Because additional capital, it could be anything between 8 lakh to 12 lakh. Their weighted marginal cost of capital is 14.75%. 8 lakh is somewhere between, 10 lakh is somewhere between 8 lakh and 12 lakh. So the weighted marginal cost of capital for raising an additional capital of 10 lakh rupees is 14.75%. Is this clear? Any doubt? So write down. The company can raise rupees 10 lakh additional capital at 14.75%. Clear? Any doubt in this? So the the weighted marginal cost of capital for raising 10 lakh rupees is 14.75%. Shall we start with the next question? Look at question number 27. Listen, this is the only question that you have on marginal cost of capital in your study material in cost of capital chapter. When you go to capital structure chapter, again there is one question on marginal cost of capital in your study material. So this is the only question that we have relating to marginal cost of capital in the study material, and so far it is not tested in your exam. So in your PYQs, I was not able to find even a single question on marginal cost of capital. So we will solve this question. 27th question I will do it in the class. 28th question, it is neither a study material question nor a PYQ or MTP RTP question. I have included this question just for your practice. So you can take it as your homework. Question number 27, study material question. I will do it in the class. So look at question number 27. ABC Limited has the following capital structure which is considered optimum as on 31st March 2022. Now here they are saying that they have a capital structure. First I'll explain what is capital structure and then we will discuss. See, capital structure is nothing but while calculating weighted average cost of capital, we are calculating the weights, 30% equity, 50% debt, 20% preference. So that percentage is nothing but the capital structure. So in this question, what is the total capital employed by the company? 2 lakh. Out of 2 lakh rupees, 30,000 came in the form of debentures. So what is the proportion of debenture in the total capital? 15%. 15% debentures. Preference is 5%. Equity is 80%. Right. So the capital structure of the company is 80% equity, 5% preference and 15% debentures. They are considering this capital structure as the optimum capital structure. Now, what is optimum capital structure? Optimum capital structure is the point where weighted average cost of capital is minimum. Don't write it. We will discuss it in the next class. Next chapter. We will start with the next chapter today itself. Capital structure, we will start it. So, for now, what you need to understand is optimum capital structure is the point where weighted average cost of capital is minimum. If weighted average cost of capital is minimum, it is good for the company or bad for the company? It is good for the company because cost is less, right? So if weighted average cost of capital is minimum, it is good for the company. So what is important to understand is, even if the firm is raising additional capital, they are not going to change this proportion. This proportion of 80% equity, 5% preference, 15% debentures will be maintained at all levels of capital. It is an assumption. Clear? Any doubt? Why we are making the assumption? Because in the question it is mentioned that the capital structure is optimum. Right? Clear? The company has a share market price of rupees 23.60. What is this? P0, the market price of the share. Next year dividend per share is 50% of the year 2021 EPS. What is the EPS for year 2021? 2.36. So this 2.36 is nothing but, before that, following is the trend of EPS for the preceding 10 years, which is expected to continue in the future. So 2021 EPS is 2.36. Out of this 2.36, the company is planning to distribute 50% dividend, so remaining 50% is retained earnings. Clear? So what is 50% of 2.36 we get? 1.18. This 1.18 is B0 or D1? D1. Why? Because it is mentioned in the question next year dividend. Right? So it is a D1. Now the company issued new debentures carrying 16% rate of interest, and the current market price of the debenture is rupees 96. Preference shares of and before that, listen, there is already an existing debenture. How many percentage debenture is there? 14% debenture is existing debenture. On top of that, they are issuing another 16% debenture. Clear? So this is a new issue. And then we have preference shares of rupees 9.2 with an annual dividend of rupees 1.1 per share were also issued. The company is in 50% tax bracket. Now what is this 9.2? The price at which the preference shares were issued. 1.1 is nothing but the preference dividend. So it is with the help of these two numbers we can calculate the cost of preference share capital. Right? Before that, this debenture and this preference share is redeemable or irredeemable? It is irredeemable. Why? Because they have not mentioned anything about the maturity. Right? So we have to use the irredeemable formula in this question. Now, the requirement of the question is calculate after tax cost of new debt, cost of new preference shares and cost of new equity share. Now assuming new equity from retained earnings, which means they are raising some additional capital. That additional capital is financed with debentures. The additional capital is financed with 16% debentures and preference shares and also with equity. But that equity does not contain any new issue of shares. It contains 100% retained earnings only. Is this point clear? So the company is raising additional capital without issuing shares or with issuing equity shares. Without issuing equity shares, the company is raising additional capital. Now, the requirement of the question is to calculate cost of new debt and cost of new preference shares. Again, listen, they are not asking us to calculate the cost of this 14% debenture and 11% preference shares, because these two are your existing debenture and existing preference shares. They are asking us to calculate the cost of new debenture and new preference share. Clear? Any doubts so far? So let's start with this question. Question number 27. See, we have 4 requirements in this question, A, B, C and D. First, let's do the requirement A. calculation of new cost of debt, cost of preference share and cost of equity. In this case, cost of equity is nothing but cost of retained earnings. So it is better to write it as KR, because there is no new issue of equity shares. The equity is coming in the form of retained earnings only. So first, let's calculate the KD. So here, the 16% debenture is a redeemable debt or irredeemable debt? Irredeemable debt. What is the formula for calculating irredeemable debt? I mean cost of irredeemable debt? I into 1 minus T divided by NP. Now listen, in this question, they have mentioned the company issued new debentures carrying 16% rate of interest. So the 16% is what? Coupon rate. But what is the face value of the debenture? Face value is 100. So you should take 16% of 100 or 16% of 96. Why? Because see, you should never calculate interest on market price. Interest should always be calculated on the face value. We already discussed in the first class itself, right? In this case, face value is not mentioned. If nothing is mentioned about face value, it is better to assume it as 100. But again, now let's say in this question, they have given market price of the debenture is, let's say, 960 rupees. Now what you will assume? Face value is equal to, take it as 1000, right? Don't take it as 100. So now, what is the amount of interest the company will pay? 16 rupees, which is nothing but 16% of 100 into 1 minus tax rate is 0.5 divided by, what is the net proceeds that we have to take? 96. Because if it is a new issue, we have to take the issue price. Issue price is not given, so we can assume that the debentures are issued at the current market price, which is 96. So 8 basically 8 by 96, how much? 8.34%. Clear? Now calculate the cost of preference share capital. Here preference, again it is a irredeemable preference share. What is the formula for calculating cost of irredeemable preference share? It is PD divided by NP. So preference dividend is how much? 1.11 per share. The issue price is 9.2 per preference share. So we get cost of preference share as 12%. Then we will take 11.95 itself. 5, we will take 11.95 or we will take 11.96. Now cost of new equity. Listen, calculation of cost of new equity. In this case, which approach can you use for calculating the cost of equity or cost of retained earnings basically? We can take Gordon's approach, but growth rate is not directly given in this question. Growth rate is, you can calculate growth rate here, right? How can you calculate growth rate? 10 years before. Yes, actually here it is very easy to calculate growth rate, but if you want to use the formula, 10 years before EPS was 1 rupee. After 10 years it has increased to 2.36. So you can take 1 into 1 plus g the whole power, 10 is equal to 2.36. But don't do it, listen. This you can, if you want to do this, you have to take the 30 power and all. You have to take that, you have to press that square root 12 times, you have to perform all those steps. But here you can directly see it is growing by 10% every year. Growth is actually evident. 1 rupee is the EPS in 2012, 1.1, which is nothing but 10% growth rate, again 10% growth rate, 10% growth rate. So you can directly take growth rate as 10%. Clear? Any doubt? Did you all understand how growth rate is 10%? Any doubt in this part? So now what is the formula for calculating cost of retained earnings here? Gordon's approach. D1 by P0 plus G. So cost of retained earnings is equal to, what is D1? No, we calculated, no. D1 is 1.18, which is nothing but 50% of 2021 EPS. 1.18 divided by market price of the share is 23.6 plus growth rate is 0.1. So what is the cost of retained earnings? We get 0. Which is nothing but 15%. Clear so far? Any doubt in this calculation? Cost of equity clear? KD? What percentage you want to take? You have to take 16% of 96. You can't take 16% of 96 because the first class we discussed see in this question we have something called 16%. No. In this question we have 16%, right? That 16% is nothing but coupon rate. This coupon rate needs to be applied on the face value. When I say it needs to be applied on the face value, it needs to be multiplied with the face value. You can see it over here. Interest or coupon rate is applied to the face value of debenture to calculate interest. So interest is calculated on face value and not on market value, because market value is fluctuating. The company has promised to pay interest to the debenture holders on the face value of the company. But in this question, this face value is not directly given. We can assume it as, if nothing is mentioned, we can assume it as 100 rupees. Right? Clear? So any doubt in the first requirement of the question till this part clear? Now let's do the second requirement. Calculate marginal cost of capital when no new shares are issued. Now listen, we know that the company is raising additional finance in the form of 16% debentures, preference share capital and retained earnings. Now they are raising this additional share capital, no. They are raising additional finance, no. For this additional finance, what is the marginal cost of capital? So that is what we need to calculate. Write down requirement B, calculation of weighted marginal cost of capital. Source, funds, weights and cost. So the additional finance is raised in the form of debentures, preference share capital and retained earnings. There is no new equity share capital issue. Retained earnings. Now what is the funds amount? How many rupees is raised in the form of debenture, how many rupees in the form of preference share capital, and how many rupees in the form of retained earnings? How many rupees in the form of debenture, how many rupees in the form of preference share capital? It is not given. If you are not calculating the funds, then how we will calculate the weights? Weights is going to remain the same. Why? Because this is the optimum capital structure. Even the company is raising additional finance, these weights will not be disturbed. So here, information relating to the funds is not given, but still we can calculate only retained earnings amount. How to calculate that we will do in the next part. We can calculate retained earnings amount, or else quickly I will tell you how we can calculate it. Out of this EPS of 2.36 rupees, 1.18 is paid out as dividend. Remaining how many rupees is there? 1.18 is there. How many equity shares are outstanding? 10,000. So 10,000 into 1.18 we get 11,800. So 11,800 is the retained earnings of the company. So we can calculate only the retained earnings amount, but nothing is mentioned about the debentures and preference. Please don't write this 30,000 and this 1 lakh there, because they are the existing debentures and existing preference share capital. But we are calculating what? Marginal cost of capital, which is the cost of raising additional debt and additional preference and retained earnings. Clear? So funds cannot be calculated. It is not given. Weights will remain the same. What is the proportion of debentures? It is 15%, 5% and 80%. Cost of debt, how much? KD? 8.33% or 8.34%. Preference share capital cost? 11.96%. This is 15%. Now W into C. How much do we get? 1.25% each. Next. Next. Let's calculate the marginal cost of capital. Settle down quickly, we'll finish this and we can go for a break.
Already done nothing.
Is chapter number 3 in the book module.
3, 4, 5.
And 1 and 2 was investment and development.
Sorry, 4, 5 and 6. 3 is ratio that we will do.
And these are
Set module 2.
separate chapters or
Separate chapters. Everything is a separate chapter.
So how many chapters are there?
Tax. Fee.
Tax.
50. Opposite or everything is not important. So what are the marginal cost of capital? Tell me this numbers and this numbers. This one 0.598. This is 12 percentage. 13.85% we can round it. So this is the weighted marginal cost of capital. Clear so far? Now look at the third requirement of the question. Determine the amount that can be spent for capital investment before ordinary shares must be sold, assuming that the retained earnings for the next year is 50% of 2021. What they are asking us to calculate, the amount that can be spent for capital investment before new ordinary shares. So what they are asking us to calculate? What is the requirement? So listen, now the company is raising additional capital using debentures, preference shares, retained earnings. Is there any new share capital? No, there is no issue of new share capital. Now this additional capital is raised through retained earnings in the sense the retained earnings is completely exhausted. Clear? Retained earnings is completely gone. They are asking to determine the amount that can be spent for capital investment before ordinary shares. So they are asking how many rupees of additional capital that can be raised before issuing equity shares. So the requirement of the question is how many rupees of capital the company can raise by making use of retained earnings, new debentures, new preference shares and existing equity, which is nothing but retained earnings, right? So they are asking us to calculate the breaking point. Clear? Now let me relate this requirement of the question to the previous question. In the previous question, this concept analyzer, what is the amount of retained earnings that we are having? 1,50,000. 1,50,000 is the retained earnings. What is the cost of retained earnings? 12%, which means before issuing share capital, the company can use shareholders fund of up to 1,50,000 at 12%. Beyond, if they want to raise additional finance by using shareholders fund more than 1,50,000, their cost of equity will change or it will remain the same. It will change. Why? Because you have to issue new share capital, right? Because till 1,50,000 it is 12%, which is nothing but cost of retained earnings. But if your shareholder fund is exceeding 1,50,000, let's say you want to have shareholders fund of 1,60,000, you can use 1,50,000 of retained earnings. For the extra 10,000, what the company will do? Issue additional equity shares. So that will have a change in the cost of equity, right? So 1,50,000 is the point at which, the range at which, what is changing? Cost of equity is changing. So similarly, in this question also, retained earnings is the point or the range at which cost of equity is changing. You're all getting the point. So, requirement C, first calculate the amount of retained earnings. Retained earnings is equal to, so what is the amount of retained earnings per share? First, what is the EPS per share? It is 2.36. Out of this, 50% is paid out as dividend, remaining 50% is retained by the company. So what is the retained earnings? Rupees 1.18 per share. But how many shares are outstanding for the company? 10,000 shares are outstanding. So 1.18 into 10,000. What is the retained earnings? 11,800. So far the company used 80% of shareholders fund, which is nothing but the company exhausted this retained earnings for raising additional capital. If they want to, they are asking what is the amount of capital that can be raised without issuing additional share capital, right? So we have to calculate the breaking point, for which the formula will be the range where KE changes divided by weight of equity. So here breaking point will be equal to, what is the retained earnings? 11,800 divided by 0.8. How much do we get? Did you all understand why did we take 0.8? Because that is the weight of equity. How much do we get? Rupees 14,750, which means the company can raise additional capital of 14,750 rupees before issuing additional equity share capital, right? Now let me put it in this way. Listen. Let's say you just write it somewhere on the side. Let's say the company wants to raise an additional capital of 14,751 rupees. The capital structure, existing capital structure is optimum. It is not going to change. So what is the proportion of equity? 80% equity or shareholders fund. So 80% equity, then 5% preference share capital, 20% or 15% debentures. 15% debentures. Now what is 80% of 14,751? 11,800 .08 or 8.8. Now listen, if the company wants to raise an additional capital of 14,751 rupees, they want 11,800.8 rupees of shareholders fund. But do they have 11,800.8 rupees? No, they have only how many rupees in the retained earnings? Only 11,800 is there. So what the company will do for the remaining 0.8 rupees? They have to issue the equity share capital. Right? I'm doing this for your understanding. Right? So you take any number greater than, you take 15,000. What is 80% of 15,000? 12,000. So the company has a retained earnings of how many rupees? Retained earnings is 11,800. But they want shareholders fund of 12,000 rupees if additional capital is 15,000. So for the remaining 200 rupees, the company should issue additional equity share capital. So 14,750 is the amount of capital that can be raised without issuing additional share capital. Is this point clear, or you want me to explain it again? Any doubt in this? Did you all understand? Huh? Only one BP here, because only one breaking point here. In the previous question we calculated 3 breaking points because there were 3 different ranges. Here we don't have those figures, no. So there is only one breaking point. So those who came late, if you have any doubt, please do ask. Listen, the requirement of the C part is determine the amount that can be spent for capital investment before new ordinary shares must be sold. So here the company is raising additional capital in the form of 16% debentures, preference share capital and retained earnings. They are not issuing any new share capital as of now. C requirement asks us to calculate how many rupees of capital that can be raised by making use of the 16% debenture, preference share capital and retained earnings. Right, so they are asking us to calculate the total amount of capital that can be raised using the existing retained earnings amount. Right, so we have to calculate the amount of capital that can be raised before issuing any new equity shares. Right, so before issuing equity shares, you will try to exhaust all your retained earnings. I hope you are getting the point. Right, what are the retained earnings of the company? 11,800. Did you understand how did we get this? So once this 11,800 is completely used for raising additional capital, the company will go for additional issue of equity shares. So this 11,800 is 80% of the total capital that we are going to raise. How do we say that? Because equity is 80%. This is an optimum capital structure. It is not going to change. So let me put it in this way. 80% of additional capital is equal to how much? 11,800. Right. Then what is the additional capital that can be raised? You will get same 14,750. Clear? So rupees 14,750 rupees of additional capital can be raised without issuing additional equity shares. Why? Because when you take 80% of 14,750, how much do you get? 11,800. So I want to raise additional capital of 14,750, out of which 80% should be shareholders fund, which is nothing but 11,800, and I have the retained earnings of 11,800, so I don't need to go for any new issue. But once we are crossing this limit, once we are crossing 14,750, the shareholders fund will become greater than 11,800. So in that case, what we have to do? We have to issue additional equity shares. Is this point clear? Any doubt in this? Requirement C? Sorry? Because the amount of debentures and the amount of preference shares is not available, no? So we can't calculate that. So did everyone understand the C requirement? Clear? So rupees 14,750 can be raised without issuing additional equity share capital. If they want to go beyond 14,750, additional equity share capital must be issued. Now look at the D requirement. Compute marginal cost of capital when the fund exceeds the amount calculated in C. So what is the amount we calculated in C? 14,750. What if we are raising capital more than 14,750? What if we are raising capital more than 14,750 rupees? In that case, what will be the marginal cost of capital? So if you want to go beyond 14,750, you have to issue additional equity shares. Assuming new equity shares are issued at rupees 20 per share. What is the existing market price? 23.6. But we are issuing the new shares at rupees 20, not at 23.6. Because new shares will be issued either at the current market price or lower than the current market price. In this case, it is issued at 20 rupees per share. So write down requirement D. So requirement D is to calculate marginal cost of capital. But before calculating marginal cost of capital, we have to calculate what? We have to calculate the cost of equity, no, here. Cost of equity is equal to, what is the formula? D1 by P0 plus G. Cost of equity is equal to, what is the D1 that we already calculated? 1.18 divided by P0 is? P0 should not be 23.6, but it should be 20. Plus, in this question, no flotation cost is given. If flotation cost is given, that needs to be adjusted. Plus, growth rate is how much? 10% or 0.1. Cost of equity how much? 10.059%. Did everyone? How 10.0? 15.9. Because when we are taking 23.6 in the denominator, we are getting 15%. Then it should be more than 15%, no, because denominator is less. 15.9%. Clear? Any doubt? Now calculate the marginal cost of capital. Source. See, actually you don't need to write the funds column, because however we cannot calculate the amount, because amount of debentures and amount of preference share is not given. So just write source, weights, cost, W into C. So sources, we have equity, then debentures and preference shares. So what is the weight of equity? It is 80%. Debentures, preference shares 5%. Cost of equity how much? 15%. Debentures cost we already calculated. Sorry, 15.9. Sorry. Cost of equity is 15.9, and debentures we already calculated how much? 3.4. Preference 11 point something, 11.96%. So multiply, here you will get 12 point something, 12.72%, 1.5%. Oh, sorry, okay. But it is only 8% of 15. No, how you will get 12 point something? Oh, 1.25. Okay. No. How it will be 12? It is 8.34, not 12.72. Second, debentures. 15% into 8.34, we get 1.25. .596. Okay, 596, we can round it to 6. Okay. So what is the weighted marginal cost of capital? 14.56%. Everyone done till this point? Clear? Any doubt? Especially if you have any doubt in the requirement C, is it clear? You got that 1.25? Clear? Requirement C, did you all understand how did we get 14,750? And what is requirement D? If we are raising capital more than 14,750, marginal cost of capital is 14.9. 5-6%. If you are raising capital less than 14,750, marginal cost of capital is 13.85%. Clear? So listen, question number 28, please take it as your homework and solve it. You can check the answers in the next class. We can start with the next chapter, capital structure. You want a break for 10 minutes? Yes. We will start at 4:20. We'll start, settle down. settle down. So listen, we are done with cost of capital. Next chapter in the financing decision is capital structure. So from tomorrow onwards you have some other subjects class. So FM will continue after a brief period of time only. So I will just give you an introduction to capital structure chapter. We will just discuss the basics, and then again once we start, I'll just brush up the basics, and then we can start with the questions from this chapter. So the meaning of capital structure. So capital structure is nothing but the composition of long-term funds in the capital of a company. So as I already told you, capital structure is nothing but, while calculating cost of capital, we are calculating the weights, right? 80% equity, 80% equity, 20% debt. So that is nothing but capital structure of the company. So capital structure tells us how the company has financed its capital, right? So capital structure includes the composition of long-term funds such as debentures, long-term borrowings, preference shares, equity shares, and retained earnings. Now, if a company is having only debt, see, before that, by definition, a company cannot have only debt. According to the definition of company, according to Companies Act 2013, the definition of company, a company cannot have only debt. Let's say a company has higher level of debt. If a company has higher level of debt, the company is considered to be highly risky because they have a fixed commitment for payment, which means whether the company is generating profit or they are incurring losses, doesn't matter, they have to pay a fixed amount of interest. So if a company is having higher level of debt, the company is considered to be highly risky company. Is it clear? Any doubt? But what is the advantage of having more debt in the capital structure? Low costs. Why? Because debt is a costlier source of finance or a cheaper source of finance? Debt is a cheaper source of finance. Why? Because debt on debentures or on debt, you are going to pay interest to the debenture holders, or you are going to pay interest to the lender of the money. On that interest, you are going to save tax, right? So interest will give you tax benefit. Interest will give you tax benefit, and interest is paid on debt. So debt is considered to be a cheaper source of finance. If a company is having only equity, it is considered to be a less riskier company. Why? Because there is no fixed commitment for repayment, right? It is not mandatory, or it is not a statutory obligation for the company to pay dividend. Payment of dividend is completely at the discretion of the company, right? Even if they earn sufficient amount of profit, the company may wish to retain a major portion of the profit. So higher amount of equity means less risky but more costly. Why equity is considered to be a costlier source of finance? Because equity shareholders expect, flotation cost is with debt also, equity shareholders expect higher return than the debenture holders. I hope you are all getting the point, right? So KE is always greater than KD. So a company should not have only debt in the capital structure, a company should not have only equity in the capital structure, but it is good to have both debt as well as equity in the capital structure. So deciding the optimum level of debt and optimum level of equity in the capital, deciding the optimum level of debt and equity in the capital structure is what we are going to discuss in this chapter. Clear? Any doubt in this so far? Did you all understand what is capital structure? Now listen, this chapter can be classified into, capital structure chapter has two major important topics that needs to be discussed. So in capital structure chapter, we are going to discuss first capital structure theories. and then we are also going to discuss EBIT, EPS analysis. So in this capital structure theory can be broadly classified into two types of theories. One is relevant theory and the other one is irrelevant theory. So in relevant theory we have NI approach, which stands for net income approach. We have NI approach or net income approach. Then we have traditional approach. And we have MM approach with taxation. So these are all the three theories that we are going to study under the head relevant theories of capital structure. Under irrelevant theory we have two major theories. One is net operating income approach, and then we have, sorry? No, see what is relevant and what is relevant theory and what is irrelevant theory I will explain. It is irrelevant in the sense it is not irrelevant from your exam perspective. Irrelevant theory we have NOI approach, and then we have MM approach. Sorry, this is without taxation. Sorry. Oh, sorry, correct. Sorry. This is MM approach without taxation. So what is relevant theory and what is irrelevant theory I will explain. But before that, in EBIT EPS analysis we are going to discuss something called indifference point. IDP is nothing but indifference point. Just write it down. Indifference point. And then we have something called FBEP, which is financial break-even point. So this is financial break-even point. So these are all the topics that we are going to study in the capital structure chapter. So in the first part of the chapter, we are going to focus on capital structure theories. So I think the first 19 to 20, first 20 questions are based on capital structure theories, and from question number 21 to question number 29 we have EBIT, questions on EBIT EPS analysis. So first let me tell you what is a relevant capital structure theory and irrelevant capital structure theory. A relevant theory tells us that if a company is bringing a change in the capital structure, it will have an impact in the market value of the company. For example, let's say a company is having 80% equity and 20% debt, and they are bringing a change in. So first, what is the capital structure of the company? 80% equity, 20% debt. Now they have changed the capital structure to 50% equity and 50% debt. So there is a change in the capital structure. So relevant theories say that if a company is bringing a change in the capital structure, it will impact the market value of the firm. Irrelevant theory says that whether the company is having 20% debt, 80% equity, or 80% debt, 20% equity, doesn't matter. Market value of the firm will remain constant, because market value is not affected by capital structure of the company, but market value is affected by the efficient operations of the company. So this is what irrelevant theory is saying. Is this clear? Did you understand what is relevant theory and irrelevant theory? Relevant theory says that capital structure will impact what? Market value. Irrelevant theory says capital structure will not impact market value. Clear? So now we will do this example, impact of leverage on EPS. Now let me tell you, after capital structure chapter, we have a chapter called leverage analysis. So that is the third chapter in financing decision. So what is leverage, how to interpret it, all these things we are going to discuss in detail in the next chapter. We are going to discuss types of leverages and how to interpret it, what does a leverage measure, all these things will be discussed in detail in the next chapter. But here we will do just this example, and the purpose of doing this example is when an organization should use debt in the capital structure. So there is a question when a company can use debt in the capital structure. In order to answer this question, we are going to solve this example. But this example has got nothing to do with the questions that we are going to solve in this chapter. But understanding this example is extremely important for understanding the next chapter. But why we are doing this example? Just to answer this question. When an organization should use debt in the capital structure. I have included the solution in the notes itself, but still I will solve it for you so that you can understand it better. Now look at this example. Total funds required by the company is rupees 10 lakh. There are two financial plans for raising this 10 lakh rupees of additional capital. Under plan A, the company can raise this 10 lakh rupees in the form of equity share capital without any debt. They can issue equity shares worth of rupees 10 lakh and they can raise this 10 lakh rupees. This is the financial plan A. Under plan B, the company can issue 50% equity shares of rupees 10 lakh and 50% of 15% debt. So what they are planning to do is 5 lakh rupees of equity under plan B and 5 lakh rupees of debt under plan B. So this total capital of 10 lakh is raised in the form of 5 lakh rupees equity and 5 lakh rupees debt. Clear? Now the tax rate of the company is given as 40%. Level of earnings before interest and tax, EBIT of this company is, under situation A it is 2 lakh rupees and under situation B it is 1 lakh rupees. Not under plan A and plan B. Within plan A we have two different situations. Within plan B we have two different situations. I hope you are understanding the point. Clear? So now let me prepare the income statement. Copy it down. Even though you have the solution in the notes, please copy it down. So here how many financial plans we have? Two financial plans we have. Financial plan A and financial plan B. So we have two financial plan A and financial plan B. Now within financial plan A there are two possible situations. Situation A is that the company can have an EBIT of how many rupees? 2 lakh rupees. And within plan A we have another situation where the company can have an EBIT of only 1 lakh rupees. So write down this is nothing but EBIT. Similarly, plan B we have two situations, A and B. Under situation A the company can have 2 lakh rupees of EBIT. Situation B the company can have 1 lakh rupees of EBIT. Clear? Now from EBIT what do we need to subtract? EBIT minus interest. So in financial plan A what is the amount of interest that will be paid by the company? There is no interest. Why? Because there is no debt in the capital structure. So in financial plan A, the interest paid by the company will be equal to 0. Clear? Now under plan B, what is the amount of debt the company is rising? What is the amount of money the company is rising in the form of debt? 5 lakh rupees. On this 5 lakh rupees, what is the percentage of interest they have to pay? Coupon rate is 15%. So 15% of 5 lakh we get 75,000. So under plan B, they have to pay 75,000 rupees of interest. So EBT under financial plan A in situation 1 is, under situation A it is 2 lakh and situation B it is 1 lakh. Here what is the EBT? 1,25,000 and 25,000. From EBT what we have to subtract? Tax. So what is the percentage of tax? 30%? 40%. Tax rate is 40%. 40% of 2 lakh we get 80,000. 40% of 1 lakh we get 40,000. 40% of 1 lakh 25. How much? 600? 500? 50,000, no? 50,000. This is 10,000. Correct? Now what is the earnings after tax of the company? 1,20,000. 60, 75 and 15,000. Is this clear? Any doubt in this? Now from EAT what we have to subtract? From EAT what we have to subtract? Listen, this is an important point that needs to be remembered throughout this chapter. So first, what is the formula for calculating earnings per share? Net income or earnings after tax divided by number of outstanding shares. But suppose preference dividend is given in the question, from earnings after tax preference dividend should be subtracted. In this question we don't have any preference dividend, but still I'll just show it over here. Preference dividend 0, 0, 0 and 0. So from EAT if we subtract preference dividend we get something called earnings available to equity shareholders. How much? 1,20,000, 60,000, 70,000 and 15,000. Earnings available to equity shareholders. Clear? Now listen, earnings available to equity shareholders should be divided with number of outstanding shares. So under plan A, how many rupees of equity share capital is raised? Plan A, what is the amount of equity share capital raised? 10 lakh. So assume face value of rupees 100 or assume face value of rupees assume face value of rupees 10 rupees per share. What is the number of outstanding shares? Here 10 lakh divided by 10, 1 lakh. Then 1 lakh here also. Under plan B, what is the amount of equity share capital raised by the company? 5 lakh. So number of outstanding shares will be how much? 50,000. So 50,000 and 50,000. So what is the EPS? 1.2 per share. Here it is rupees 0.6 per share. Here it is rupees 15,000 by 50,000, sorry, 75,000 by rupees 1.5 per share. Rupees 0.3 per share. So far clear? Any doubt on the calculation part? Any doubt? Did you all understand? Did you all understand how did we get number of outstanding shares? Any doubts in this? Now listen, the calculation is already done over here. Till EPS we have calculated, right? We will do this part later. This is nothing but return on equity. We will do this later, but before that, listen. What is important to understand here is, I've shown the analysis here. What is important to understand here is, listen, at EBIT level of 2 lakh rupees, plan B is the most attractive because EPS is 1.5 rupees, which is higher than the EPS under plan A. So, when your EBIT is rupees 2 lakh, which plan you will choose, financial plan A or financial plan B? A. Why? Because under financial plan A, you will choose financial plan B. Why? Because if when your EBIT is equal to 2 lakh rupees, EPS under plan A is only 1.2 rupees per share. But under plan B, EPS under plan B when EBIT is equal to 2 lakh, EPS under plan B is rupees 1.5 per share. So you will obviously choose financial plan B over financial plan A. Why? Because EPS is higher. Now listen, this is because of the following two reasons. Use of debt. Now here we know that 1.5 in plan B and 1.2 in plan A. Now why EPS under plan B is greater than EPS under plan B? It is because of two reasons. First, use of debt in the financial plan B. So if you are using debt, you are making use of the cheaper source of finance or costlier source of finance. You are making use of the cheaper source of finance, right? So on debt you are going to pay interest. What is the amount of interest paid by the company in this question? 75,000 is the amount of interest they are paying. Because of paying interest to the debenture holders, they are going to get tax benefit, right? But if you are not taking debt, you will not get any tax benefit. So EPS under plan B is greater than EPS under plan A because of two reasons. First, use of debt in financial plan B, and the second reason is return on total asset is more than the cost of debt. Listen, the second point is important to understand. What is the total amount of return the company is generating? What is the EBIT of the company? 2 lakh rupees. So this is their operating profit, right? Now I am talking only about situation A. We will get back to situation B later. Situation A, what is the EBIT? 2 lakh. Now 2 lakh is the profit the company generated. By making how many rupees of asset, by making use of how many rupees of asset, the company generated 2 lakh rupees of profit. Why 10 lakh? Because the company raised additional capital of 10 lakh. What they are going to do with this 10 lakh? Company will invest this money in the business, right? So return on asset is equal to EBIT divided by asset. So what is the EBIT of the company? It is 2 lakh and asset of the company is 10 lakh. So what is the return on asset the company generated? It is 20%. So return on asset of the company is 20%, but what is their cost of debt? KD is how much? Look at the question. KD is how much? Only 15%. So cost of debt is only 15%, but return on asset is 20%. So return on asset is greater than cost of debt. So in such a situation, it is better to use debt in the capital structure. So first point that we need to understand here is, if return on asset is greater than cost of debt, beneficial to use debt in the capital structure. If you remember the first example that we did at the beginning of the cost of capital chapter, if return on asset is greater than cost of capital, the company will have surplus funds, right? So that is what we discussed. So similarly, if return on asset is greater than the cost of debt, it is beneficial to use debt in the cost of debt because the company is generating more profit, then what is the amount of interest that they need to pay? Is this point clear to everyone? Now, if return on asset is greater than cost of debt, it is beneficial to use debt in the capital structure. That is what we studied. Now, what is return on asset? 20%. Cost of debt is 50%. Now, when your EBIT is 2 lakh rupees, which plan you are choosing? Plan A or plan B? Plan B. Plan B has debt in the capital structure or no debt in the capital structure? Has debt in the capital structure, right? So, to summarize everything, when EBIT is 2 lakh, the company is generating return on asset of 20%, which is greater than the cost of debt of 15%. So the company should choose to have debt in the capital structure. Which plan has debt in the capital structure? Plan B. So they will obviously go with plan B. Clear? Any doubt in this part? Now look at the analysis. Second, number of shares is less. When you look at you should not take the decision based on earnings available to equity shareholders or net income. In this case, both are same. You should not take your decision based on the net income. Why? Because the number of shares in plan A is 1 lakh. Number of shares in plan B is 50,000. So this 1,20,000 rupees is the amount available for 1 lakh shares. 75,000 is the amount of profit available for only 50,000 shares. Right? Now look at the second point of the analysis. At EBIT level of 1 lakh rupees, when EBIT of the company is 1 lakh rupees, plan A is the most attractive because EPS is 0.6, which is higher than the EPS of 0.3 under plan B. Now let's say EBIT of the company is only 1 lakh rupee. What is the EPS under plan A? 0.6. If EBIT is 1 lakh, what is the EPS under plan B? 0.3. Which one we will choose? Obviously plan A. Why? Because EPS is higher. But why EPS is higher? Why EPS is higher? Why we are choosing a plan without debt? We are choosing plan A, right? Because EPS is 0.6. Why we are choosing a plan without debt? Listen, second point. What is the return on asset under this situation? When EBIT is only 1 lakh rupees, what is the return on asset? 1 lakh divided by 10 lakh. What is the return on asset? 10%. What is cost of debt? Return on asset is 10%, but cost of debt is equal to 15%. So return on asset is lesser than the cost of debt. So it is better to have debt in the capital structure, or it is better to avoid debt in the capital structure. So if return on asset is less than cost of capital, better to avoid debt in the capital structure. Clear? Any doubt in this so far? Did you all understand this part? So now listen. When EBIT is equal to 1 lakh rupees, plan A EPS is 0.6, plan B EPS is 0.3. Plan A EPS is greater than plan B EPS because of two reasons. One is use of debt in the financial plan B. Listen to this point carefully. Let me show the numbers from here itself. When the company is generating 2 lakh rupees of EBIT, what is the interest they are paying? 75,000. When they are generating a profit of 1 lakh rupees, what is the interest they are paying? 75,000. So for 2 lakh rupees profit also you are paying 75,000 interest. 1 lakh rupee profit also you are paying the same 75,000 interest. Why? Because debt is a riskier source of finance. Whether you are generating 2 lakh profit, 1 lakh profit, or 3 lakh profit, or 5 lakh profit, doesn't matter. You have to pay fixed amount of interest. Clear? Any doubt in this? So this is the reason why when EBIT is just 1 lakh rupees, When EBIT is 1 lakh rupees and you are going with plan B, what is happening? A major portion of your EBIT is taken by the debenture holders. So only only 15,000 rupees is left for the equity shareholders. I hope you are all getting the point. Is it clear? Any doubt? So in such a scenario, when EBIT is only 1 lakh rupees, it is better to avoid debt in the capital structure so that you can escape from paying interest of 75,000. Clear? Any doubt? So did you all understand this analysis part? So when an organization should have debt in the capital structure, when return on asset is greater than cost of debt, company should have debt in the capital structure. When return on asset is less than cost of debt, better to avoid debt in the capital structure, right? See, we will get back to these points in our further discussion also. If you want, let me show it quickly. So listen while doing this part, while doing this indifferent point analysis, while explaining this graph, we will again get back to this. We will again get back to the example that we discussed now. And when you look at the next chapter, leverage analysis, you can see that it is mentioned in your study material also. You can see it over here. When return on asset is when return on investment or return on asset, because see in this question, the capital raised by the company is how much? 10 lakh. What is the amount they are investing? What is the amount of investment made? 10 lakh itself. So in what they are investing? Assets. So return on investment and return on asset plus or minus the same. So return on asset or return on investment is greater than cost of debt. It is better to have debt in the capital structure. Return on investment is less than cost of debt. It is better to avoid debt in the capital structure. So this point again we will discuss in the next chapter, leverage analysis as well. Clear? Sorry, leverage is part of chapter 3, leverage analysis. But see, cost of capital, capital structure and leverage analysis, these three chapters are interlinked. Without understanding cost of capital, understanding capital structure will be slightly difficult, because if you look at this question, find weighted average cost of capital. So in capital structure also we have to calculate weighted average cost of capital. So here also you can see overall cost of capital. They are asking us to calculate cost of equity. So listen, we will do this further analysis quickly and then we can move to the next topic. So further analysis of plan A. Just look at plan A over here. If EBIT decreases by 50%, where like here it is 2 lakh. When you are decreasing EBIT by 50%, then EPS decreases by 80%. You can see it over here. What is the decrease in EPS? From 1.2 to 0.6. It is decreasing. No? Calculate the percent. Oh, it is 50. Sorry. Wait. Sorry, my bad. Wait. Since the numbers are same. Okay, wait. Listen. Plan B. Okay, let me take from here. So let's compare these two plans. Oh, okay, correct. Sorry. This is further analysis of plan A. Correct. Listen. If EBIT decreases by 80%, then EPS also decreases by 50%. You can see it happening over here. By how many percentage EBIT is decreasing? There is a 50% decrease in EBIT. By how many percentage EPS is decreasing? 50%. So decrease in EBIT is exactly equal to decrease in EPS, right? But when you look at plan B, just listen, just look at plan B over here. When EBIT decreases by just 50%, your EPS decreases by 80%. You can see that happening over here. There is a 50% decrease in EBIT. By how many percentage your EPS is decreasing here? There is a 80% decrease in EPS, right? Why it is happening? In financial plan A, 50% decrease in EBIT leads to 50% decrease in EPS. But in financial plan B, 50% decrease in EBIT leads to 80% decrease in EPS. It has got nothing to do with tax. It is just because of the amount of interest that we are paying. When we are generating 2 lakh profit, we are paying interest of 75,000. When profit is 1 lakh, still we are paying interest of 75,000, right? So, irrespective of the profit that you are generating, you are paying a fixed amount of interest. So, a small change in EBIT leads to a larger change in EPS. I hope you are all getting the point. Is it clear? Still you have any doubt in this? Or else let me put it in this way. Listen. What is the EBIT that we have generated? 2 lakh. After the payment of interest, what is the EBT we are left with? 125 rupees, right? Now, see, this is beyond the scope of this chapter. We will discuss it in a greater detail in the next chapter. But let me tell you, you can easily understand it. Let me quickly tell you, when you divide this EBIT with EBT, you get something called DFL, right? So what is EBIT in this case? It is 2 lakh rupees. What is EBT? 1 lakh 25,000. So what is your DFL? 1.6. So listen, how to interpret this 1.6, I will tell you quickly. Now we are doing this for plan B. I will show it for plan A also, so that you can understand it easily. So this is for plan B. Listen, we are getting a DFL of 1.6, right? It means that for every 1% decrease in EBIT, there will be a 1.6% decrease in EPS. Again I am repeating, for every 1% decrease in EBIT, there will be a 1.6% decrease in EPS. In this case, by how many percentage EBIT is decreasing? EBIT is decreasing by how many percentage? 50%. For 1% decrease in EBIT, there is going to be a 1.6% decrease in EPS. Then for 50% decrease in EBIT, how many percent decrease in EPS? 1.6 into 50, you are getting 80%. That 80% is nothing but this 80%. Did you understand how did this come? Clear? Now why it is not happening in financial plan A? Listen. In financial plan A, what is the EBIT? 2 lakh. What is EBT? 2 lakh. What is DFL? 1. So for every 1% decrease in EBIT, there will be a 1% decrease in EPS. For every 50% decrease in EBIT, 50% decrease in EPS. I hope you are getting the point. So in financial plan A, the decrease in EBIT is proportional to decrease in EPS. Why? Because there is no interest. Because of no interest, EBIT and EBT are same. I hope you are all getting the point. But in financial plan B, we have interest. So, DFL is 1.6, which means for every 1% decrease in EBIT, there is a 1.6% decrease in EPS. Is this clear? Any doubt in this? Did you all understand this part? Clear? Fine. Now, what is important is, see, the ultimate objective of doing this question at the beginning of the chapter is to answer this question. Should a firm employ debt or not? Use of debt will have a favorable impact on EPS and return on equity if return on asset is greater than interest cost of debt. So, if return on asset is greater than KD, the company should have debt in the capital structure. Use debt in the capital structure. If return on asset is less than cost of debt, better to avoid debt in the capital structure. Even if you have understood at least some 40% or 50% of this analysis and further analysis, we are going to discuss the same thing in next chapter. So don't worry, we will discuss it in a greater detail at that time. Clear? So now we discussed what is capital structure. Is this? I hope it is clear. Then we discussed when the firm should have debt in the capital structure. Now, why it is necessary to study the capital structure? Listen. The ultimate objective of studying capital structure is to determine the optimum level of capital structure. So we are studying capital structure to determine optimum level of capital structure. Now what is an optimum capital structure? An optimum capital structure is nothing but the level of the optimum capital structure is the point where overall cost of capital of the company is minimum. If overall cost of capital of the company is minimum, value of the firm will be maximum. And we can maximize the wealth of the shareholder, which is nothing but the ultimate objective of the financial management. Is this clear? Why we are studying capital structure? To determine the optimum capital structure. What is optimum capital structure? It is the point where cost of capital is minimum and value of the firm is maximum. Right? Now after doing this example, you will be able to understand it clearly. So after this example, we can call it a day. Right? We will continue with the next topics in the further sessions. So you look at this example. Cost of debt and cost of equity share capital at various levels of debt equity mix are estimated. So the company can have, here listen, when proportion of debt is 0, what is the proportion of equity? 100% equity. Here proportion of debt is 20. So here 40% equity. Clear so far? Any doubt in this? Clear? Now. Oh, here it is already given, sorry. Okay. So cost of debt is 10% and cost of equity is 14% given. When there is no debt and 100% equity, there is a cost of equity of 14%. When there is 20% debt and 80% equity, cost of debt is same 10%, but cost of equity is also same 14%. When debt is 40% and equity is 60%, cost of debt is 11% and cost of equity is 16%. So you can see that as the company is adding more and more debt into the capital structure, cost of debt is also increasing, cost of equity is also increasing. How cost of debt is? No, which means in this case the company is not at all using cost. Okay, I will explain that point, just listen. So when the company is using 60% debt and 40% equity, cost of debt is 13% and cost of equity is 20%. Right? Now listen. In this case, the first scenario is the company using any debt. There is no debt. So we can say that the company is not using debt, but they are using only equity. So we can say that weighted average cost of capital is exactly equal to cost of equity. That's all. I hope you are getting the point. Got it? See, it is not, you should not understand it like that, which means if the company is not having, or if the company is having, okay, let me put it in this way. Let's say a company has 100% equity. It is a less risky company or more risky company? Company has 100% equity. It is a less riskier company. Why? Because there is no fixed obligation to pay interest, right? So it is a less riskier company. So a company with less risk can borrow at a lower interest rate or at a higher interest rate. Lower interest rate. So let's say a company is 100% equity. There is no debt, a debt-free company. If they want to borrow money, they can borrow at 10% debt. Right? But look at case C or case D for that matter. The company has 50% debt, 50% equity. Let's say this is company A and this is company B. Company A has no debt, only equity. Company B has 50% debt, 50% equity. Which company is more riskier? B is riskier. Why? Because they are using debt in the capital structure, right? So company B can borrow debt at what rate? 12%. So they have to borrow at a higher percentage of interest. Why? Because they are having financial risk. But company A does not have any risk, right? So borrowing rate of a debt-free company will be lesser than the borrowing rate of a company which has debt, right? I hope it is clear. It is not that without debt the cost is 10%. No, not like that, right? So now what we are supposed to do is, for this various levels of finance, we are supposed to calculate weighted average cost of capital. Why we have to calculate weighted average cost of capital? Because we have to determine the optimum capital structure. What is the optimum capital structure? The point where the cost of capital is minimum. So calculate WACC for each level and take the point where cost of capital is minimum. That is the optimum capital structure. So listen, what is the weighted average cost of capital in situation A? How much? Just 14% because there is no debt. Here, you do that, you have the weights, you have the costs calculated. WACC, scenario B, how much? 13.2. Next. $27, no way. Exactly 14. 0.4 into 0.11. So 4.4 and yeah, exactly 14%. Okay. Next. Next. Now, where the cost of capital is minimum? When there is a 20% debt, 80% equity, cost of capital is minimum, 13.2%. So what is the optimum capital structure for this company? It is better to have 20% debt and 80% equity as the capital structure. Why? Because cost of capital is minimum at this point. Clear? Any doubt? Now one more point, listen. When cost of capital is minimum, value of the firm is maximum. How and why we will discuss later, right? So that we will discuss while discussing capital structure theories. So here you can see that cost of capital is minimum at 13.2%. So the conclusion is the company can have 20% debt and 80% equity. So that is the optimum capital structure for the company. Clear? So now from this part we will discuss in the subsequent lectures.